All right. So, conceptual framework was done last class, and please do have a read through all of those material that I've sent you. Make sure you're aware about all the definitions. That could be an area where they could ask you questions. So please make sure you don't leave any stone unturned. Do your extra questions from the practice questions from your book, whatever publication you're following. I'm indifferent to whatever it is that you follow, but make sure that you are working your way out through all of those questions. Okay, that is very important. Do that for every standard as and when we are teaching. Okay, so whatever standard we finish, go back and do extra questions, practice questions from your revision kit. Okay, if it is, of course, like we don't have that much amount of time to go through each and every question, so I will be finding out the most important questions and I would be doing them in class, which would give you a fair idea about how you can be tested in these what kind of exam standard questions you can expect from each standard. But as and when you practice more, it will give you more idea regarding how you can move ahead and prepare yourself for the exams. Okay, so that's essentially our target. So today we will be discussing on IS 16. I had asked you to read and come. So what does IS 16 essentially cover? IS 16 talks about what? Tangible assets. Okay, mostly talks about tangible assets. What do these tangible assets means? Tangible assets essentially mean they are um, they are assets which are physically present in the company's premises. When you see tangible assets, you can trace them back in your balance sheet. You can also physically trace them to your premises. In fact, if you end up working in audit and you are working in internal audit, for example, then there will be a fair chance that sometimes you may have to go and physically verify if a particular asset actually exists in the company's premises or not, as the company claims. That's how auditing is done. It's called verification of physical assets. So tangible assets, essentially IS 16 talks about tangible assets, property, plant, and equipment. These assets are held by entity for use in what? Production of goods and services, for rental to others, or for administrative purpose. Production of goods and services for rental to others or for administrative purposes. You can find the definitions in any publication you follow. I'm not going to be writing them again. I will reiterate once. It is your responsibility to go through the textbook and understand the definitions and everything. My primary aim here is to practice exam standard questions. I will just touch upon the definitions. If you have any doubts anywhere, just let me know. Okay. So tangible assets held by the entity for use in production of goods and services, for rental to others, or for administrative purpose. Three things: production of goods and services, rental to others, or administrative purposes. They're expected to be used during more than one period, which means that for more than 1 year, you can expect these assets to be in your balance sheet or to be operative in your business. Okay. So production of goods and services, rental to others, or administrative purpose. Okay. Now, how do you recognize something as an tangible non-current asset? We go back to our definition of asset from our conceptual framework. It must give you probable future economic benefits, and it must be measured. It must have a reliable measure of cost or value. Measure of cost or value. A reliable measure of cost or value. That is essentially the two recognition criteria that I have under IS 16. If I have both of these recognitions, then probably the element that I'm looking at can be classified as IS 16 tangible non-current asset. Okay. So far, so good. Getting the point. Everyone okay? Yeah. Right. Next is, how do I measure? How do I measure these particular assets? Measurement means what? The value that I'll be writing next to these assets on my balance sheet. How do I know that this is the value at which it will be measured? Okay. So initial measurement It is always at cost. Initial measurement is always at cost. What do these costs include? What are the costs that I can include? Costs, all costs which are directly attributable to bringing the asset into necessary working condition or location for its intended use. All costs which are directly attributable. The key word is directly attributable costs. These costs can be included as part of costs for the IS 16 assets. So all directly attributable costs which are responsible for bringing the asset into necessary working condition or location for intended use, which means that if you have an asset and you have, let's say, you have ordered a particular asset from a particular supplier, okay? The supplier then has to send them to your premises, because unless and until the asset is at your premises, it is not operational. So you will be incurring what? The supplier, not supplier, essentially you will be incurring the costs of transportation. So transportation cost is a directly attributable cost. Why? Because unless and until the asset is physically transferred from the supplier premises to yours, it can't be operational, it can't be used. So simple. So all costs which are directly attributable to bringing the asset into necessary working condition or location for its intended use, those costs will be included under your IS 16 assets. Those will be the costs which will be added in your initial measurement. So all directly attributable costs, remember this keyword, directly attributable. Okay. So what costs are excluded? I will be excluding certain costs. For example, general and administration overheads. General and administration overheads, these can be excluded. Abnormal wastage, that can also be removed. Any costs incurred after the asset is ready for physical use. Any costs after the asset is ready for physical use. Okay. General and administrative overheads. You will be incurring these costs irrespective of whether you are using an asset or not using an asset in your premises. Abnormal wastage, something which is not related to the asset, cannot be considered directly attributable. Any costs after the asset is ready for use. After the asset is ready for use, it means that those costs are not directly attributable to bringing it into necessary working condition or location. It is costs incurred after it's ready for use, already installed in the premises. So those again will not be a part of your directly attributable costs. So whenever you're looking at a certain cost, the first thing you have to ask yourself is this cost directly attributable? If it's not, then you cannot include it as part of your cost of asset. Okay, is that okay? Is everybody getting this simple stuff? Quickly, yes or no? We don't have all day. We have a lot to practice. There's 43 of you. All right. Next. How can you measure? So I know what to include in my costs, but measurement has two levels, two models. Sorry. Measurement has two models that I can use. Number one is cost model. What does cost model say? Simply put forward, cost model will include the historical cost minus any accumulated depreciation minus any impairment. That is the way you measure an asset if you have hold it under cost model. But in your exam questions, most will be based around revaluation model, which means what? Fair value minus the accumulated depreciation minus the impairment loss. Fair value is nothing but the market value of the asset. IS 16 as a standard does not make a differentiation between cost model or revaluation model. It is up to the user. They can choose whether they want to carry their asset under cost model or revaluation model. If you're carrying it under cost model, you will be using the historical cost and you will be deducting the accumulated depreciation and impairment from it. If you're using the revaluation model, you will be using fair values, which is nothing but the market value of the asset minus the accumulated depreciation minus the impairment loss. Okay. So have a look at what they have told you in the exam question. Sometimes the examiner just wants to test you. They will say that, look, the current fair value of the machine is this, but we have hold the machine under cost model. that case fair value can't be used. You will have to use the historical cost. So sometimes they do this. In an exam question, they would give you both the historical cost and the fair value model, the newer fair value. And they will tell you that you have elected to carry it at cost model. So you can't use the fair value model. You can't use the fair values given to you. So that fair value number, which is given to you in the question, is there primarily for the purpose of confusing you. So you need to understand, you need to get the in-depth information about what you are actually studying. If you understand it very well, no question will be able to confuse you, right? So if it's cost model, I will use historical cost for valuations. If it's revaluation model, I will use fair value for valuations. Make sense? Make sense, all of you? Okay, next. So this is all about the basics of IS 16, the definition, tangible assets held for the entity for use in production of goods and services rendered to others or administrative purpose. We know that recognition criteria is two things: probable future economic benefits, reliable measure of cost of value. Again, this is something which is derived from our conceptual framework itself. If you go into the definition of what the asset was, it's a present economic resource controlled by an entity because of a past event that can provide future economic benefits. So we are drawing inspiration again from the conceptual framework to find out the recognition criteria of assets under IS 16. So everything is interrelated. Then you will initially measure them at costs, exclude the costs which are not directly attributable. Keyword directly attributable. Measurement can be done either on the basis of cost model, use historical cost there, or revaluation model, use fair values there. Simple. Now, I have a question for you. What is residual value? What do you mean by residual value? How does it affect the way I calculate my depreciation? Residual value is scrap value, is it? Okay. Well, is it? Hmm. One of the examples of residual value is scrap value. Okay. Well, you can say that's to a certain extent, yes, but not all the cases. Okay. So when I'm talking about residual value, I think the better definition you can say is that residual value is something on which you just cannot charge depreciation. It's not, in most cases, you're right. In most cases, it's scrap value, yes, but not in all the cases. Okay. So scrap value is something like, okay, look, my asset can no longer be used. I have to scrap it. I have to just throw it out. And somebody is saying that, okay, I'll buy the scrap at $2,000, something like that. Okay. But sometimes you have established code of conduct with certain companies. The company says that, look, if this asset is this much old, I will take it back for this price. And they will renew this asset and it will be used again. So in that case, it's not necessarily scrap. Okay, scrap means no further use. Okay, you can't use it any further. But sometimes they can be taken, they can be recycled, they can be used for some other purpose. In that case, I can't necessarily say it's scrap value. Okay, you're right. In most cases, the residual value is scrap value, right? Okay, that's good. At least we are on the same page. So I'll give you an example. The cost of an asset is $100,000. This is the cost of an asset. My residual value is $20,000. My useful life is 8 years. What is my depreciation per year? 10,000. Others? 8,000. 10,000. Okay. Mm-hmm. So residual value is what? Scrap value. Can I charge depreciation on residual value? No. So what will I do? Simple stuff. 100,000. I will deduct the residual value first. I took off the residual value. How much do I have? 80,000. What is this 80,000 called? What is this 80,000 called? Carrying value? No. What is this 80,000 called? Why is this thing? Minimize itself. 1 second now. Mm. Depreciable amount. Yes, perfect. That's not the carrying value. We have not been to the carrying value yet. This is the amount on which you will charge depreciation. Hence, it is this 80,000. It is known as depreciable amount. Okay. Now, how much is my depreciation? Therefore, my depreciation will be charged on 80,000 over my useful life of 8 years, which is 10,000. This is my depreciation. What is my carrying value at the end of first year? What is my carrying value of this asset at the end of first year? 70,000. How did I find out? 80,000 minus the 10,000, I get 70,000. For people who are confused, you have three different terms. First, depreciable amount, the amount on which I can charge depreciation. Anytime you have been given a residual value, you cannot charge depreciation on the residual value. Why? Because you will get this amount back at the end of selling the asset. This is essentially your scrap value, as you said. So you would get it back. There is no way you can charge depreciation on amount you're getting back. So residual value, no depreciation can be charged. That has to be removed from my cost. So when I remove my residual value, I get my depreciable amount, essentially the amount on which I can charge depreciation. That is my 80,000 in this case. 80,000 is my depreciable amount. So I go ahead and I charge my depreciation, which is how much? Depreciable amount over my useful lives, which is 10,000. This is my depreciation, the amount of depreciation that I have charged. Now you will have to find out the carrying value. Carrying value is what? The cost minus what? The depreciable amount. 1 second now. Okay, depreciation you have already calculated. The next is calculating your carrying value. So carrying value will be your cost minus 10,000. We have done one mistake here. So let's see who finds it out. What is the mistake? And explain the mistake. The carrying value calculation is wrong. Why? What is carrying value? Explain the concept of carrying value. What does it mean? Amiksha, be a little careful with your commas. Okay, you're writing 1 lakh. You have to write it's 100,000. Okay, there is no concept of 1 lakh in your exam. You have to write 100,000. Yes, carrying value is 90,000. Right. This 80,000 is my depreciable amount. You don't carry. The formula of carrying value is cost minus depreciation. My cost is 100,000. My depreciation is 10,000 calculated on my depreciable amount of 80,000, right? So essentially, my carrying value is 90,000, not 70,000. A very common mistake in the exam, what people do is they take this 80,000 and they deduct 10,000 from it. 80,000 is your depreciable amount, not your cost. Your carrying value is not calculated on your depreciable amount, it's calculated on your cost. So it's 100,000 minus 10,000, which is 90,000. Make sense? For everyone who's going to be using commas in your exam, be very careful. Do not write 1 lakh. You have to use 100,000. Use the million numbers. Okay. So, what kind of questions they can ask? Anything. Depreciable amount, the amount of depreciation, or the carrying value of the asset. All of these three could be tested in your exam. You need to have clear-cut understanding of all of these three terms. Depreciable amount will only come into existence whenever there is some residual value. In that case, you cannot charge depreciation on the cost. You will charge it on depreciable amount. But remember, carrying value is cost minus depreciation, not depreciable amount minus depreciation. Okay? Clear? Make a clear note of this. Do not make this mistake. Okay, these are easy questions, easy marks. If you make mistakes here, it's going to get very difficult to pass the paper. All good? Can we move on? Everyone, is it okay or are you stuck somewhere? Okay, let's move on. Okay, next thing, what are we looking at now? Let's talk a little bit about the revaluation model. Okay, okay, what does the revaluation model talk about? The revaluation model, so when we talked about measurement, we talked about two models, cost model and revaluation model. Cost model is very simple. I will just take the historical cost, subtract the accumulated depreciation and any impairment that is necessary, right? But when it comes to my revaluation model, the things take a little different turn. So revaluation model has a few rules. So if I'm electing to carry my assets under IAS 16, under the revaluation model, I would be revaluing all assets, revalue all assets in the same class. That's my first rule. Oh, revalue all the assets in the same class. My second rule is revaluation must occur with sufficient frequency. Why? So that my carrying value is not significantly different to my market value. Okay. So just write it down. Let's not be confusing. Carrying value not different from market value. Okay. Now let's understand what this means. Revaluation model means what? I will be valuing my assets at their fair value or their market value, and I will be subtracting my accumulated depreciation and impairment from it. That's the math perspective. If I have to calculate the numbers, that is how I'm going to be doing it. What does the revaluation model talk about? The revaluation model has two rules given by the conceptual framework. The rules are revalue all assets in the same class. What does it mean, same class? Let's say you are deciding to carry one of your buildings at revaluation model. You can't just carry that one particular building at revaluation model. Whatever buildings you have, all of them have to be revalued in order to be carried at revaluation model, in order to be carried under revaluation model, rather. Okay. So when I'm talking about assets of the same class, I'm talking about assets that fit a particular description. For example, buildings or land or like machines. So if I'm revaluing my machines, I will revalue all the machines that I use for the purpose of production of goods and services. If I'm revaluing my building, I'm going to be revaluing all of my buildings that I have on my balance sheet. So that is essentially what it means. Revalue all assets in the same class. Next is, what does it mean by revaluing with sufficient frequency? If you have chosen to carry your assets under the revaluation model, you will have to revalue them with sufficient frequency. Now, sufficient frequency has not mentioned any particular timeline. It does not say you have to revalue every year, it does not say you have to revalue every 2 years. No. Sufficient frequency is something that is based out of judgment. You should revalue all those assets that you hold under revaluation model with sufficient frequency so that its carrying value is not different from its market value. Okay. So the entire purpose of revaluation model is to provide what? So anything. Okay. Basic fundamentals around standards. Why do we have standards in the first place? We have them because we want to provide better information to shareholders, because shareholders use this information for making investing decisions. Everything that we do in financial reporting is based around the shareholder itself. How does the shareholder see information? So the more clarity we give, the better it is, right? Then comes the concept of revaluation model. Revaluation model says that if I'm carrying an asset under the revaluation model, I would be revaluing at assets on a regular basis to make sure that it is not significantly different from my market value. Because let's say you're carrying an asset like one of your buildings, okay? Let's say the price of the building has gone up significantly in the market. Let's say real estate. So real estate will go up with time. So let's say in and around your area, the value of your assets have gone up significantly, but your asset, it's carried under revaluation model. It does not specifically say when you will revalue. So let's say you haven't revalued in a long time, that becomes a problem. Because if you haven't revalued in a long time, the asset on your balance sheet is much lower in terms of value than what the actual price in the market is. That is the entire purpose why we want to revalue on sufficient frequency to ensure that the carrying value is not significantly different from the market value. Or else, tomorrow, if we are going to sell the asset, the values will be completely different. The asset will be carried at a very low price, but it will be getting sold at a very high price. So that would make no sense. The transaction makes no sense. Is that making sense? Revaluation model, why we have to calculate revaluations or do revaluations with sufficient frequency so that its carrying value is not different from market value. Getting my point? Good. Others getting it or going through your head? I hope it's not, because it's very simple. There's a lot of other things that will go through your head. Getting it? Okay, perfect. So, revaluation model, revalue all assets in the same class, revalue with sufficient frequency so that carrying value is not different from market value. Simple. Now, let's come to accounting entries. I have carried an asset under IS 16 and I have carried it under the revaluation model. So anytime the asset is carried under revaluation model, it will have to be revalued with sufficient frequency. Whenever I revalue, the price can either go up or go down. When that happens, how do I record that in my financial statement? So I'll just give you a common example, normal example. If I'm carrying an asset under $100, the price has increased to $150. How will I record this? What will I debit? What will I credit? Let's see who gets it. Accounting entries. Revaluation model, one of my assets has increased in price from 100 to 150. How do I take care of this adjustment? Okay, debit asset, then what? Credit what? Debit asset, credit OCI or revaluation surplus? Yes, perfect. OCI or revaluation surplus. How much? What is the amount that I'll be crediting and debiting simultaneously? Asset 150. Aishwarya? No. The value has increased by 50. I will only be accounting for the increase, not the total value of the asset. Okay. So it will be 50. Yeah. All right. Let's have a look at another thing. Another different case. My asset is valued at $200. It has fallen to $120. What is my accounting entry? Impairment loss. Did I teach you impairment loss? How do you know it's impairment loss? Did I tell you there has been any impairment? Credit asset and debit what? Debit revaluation. This is a different case, not the same case. This is another asset. Credit asset, debit profit and loss. Yes, Salman, you're right. Debit PL. Impairment loss. Amiksha, how did you know it was impairment loss? Did I tell you? It could be revaluation losses, right? I'm not talking about impairment loss. We are not talking about IAS 36 yet. When we talk about IAS 36, you can write impairment loss or normal loss for that matter. You can just write debit, profit, and loss. It's the same thing because all of them will be considered under the P&L method, right? Revaluation losses or impairment losses. But there is a difference. Impairment loss will specifically come into existence when there are indicators of impairment, right? I have not mentioned any indicators of impairment here. If I have not mentioned, you are speculating. You cannot speculate something if that's not given to you, right? So credit asset 80, debit PL 80. All right. Impairment loss will be considered only when there will be indicators of impairment. Now make sure you're getting it. So unless until there is some indicators of impairment, I cannot assume that yes, this is an impairment loss. This is revaluation loss, and this will be taken directly to profit and losses. I'm revaluing my assets and the value came lower than expected. That's a loss that I've incurred. That's all. Simple. Now, these were two isolated cases. Now I'll give you one case where I'm both revaluing upwards and downwards, and I would like you to give me the accounting entries. Let's have a look at the third scenario. So, my asset was initially valued at $100. It went up to $180. Next, so this was revaluation 1. This is revaluation 2. When I did revaluation 2, it fell to, let's say it fell to $70. Now, what will be the accounting entries that I'll be having in both the scenarios? Tell me about revaluation 1 first. What will be my accounting entries for revaluation 1 for R1? Debit asset 80. Credit what? Write both the entries together, okay? Debit asset, then credit what? Simultaneously write them at the same line. Credit OCI, same amount. OCI or revaluation surplus, same amount, 80. Then what happened? Okay. Debit asset, credit OCI 80. Perfect. Let's go to revaluation 2. What will I do with revaluation 2? Credit what? Credit asset 110. Ah, yes. Let's see. Debit OCI 70. Debit SOPL 30. Debit SOPL 110. Okay, a lot of different answers. Okay, have a look at this. Okay, listen to me now. Whenever you have a case of a revaluation of the same asset, this is the same asset that's going through two different revaluations. First is an upward revaluation because the value is increasing. Second is a downward revaluation because the asset is decreasing, right? The value is decreasing. So the way you look at this is whenever you have the same asset undergoing upward or downward valuations, if some OCI is existing before, this has to be netted off first. So credit asset, debit OCI, how much? 80. Now, how much balance is left? Another 30 remains because every accounting entry will have a debit and a credit and they have to balance. I have credited asset worth 110, but I've only debited OCI of 80. So where does the other 30 go? It goes to my profit and loss. 30. Now is it balanced? Are debits and credits matching now? Does this make sense? Right? So whenever you have a similar case of asset revaluations that's simultaneously undergoing upward or downward revaluations, in that case, you will first net off the existing OCI, if there is any, and then move on to charge the remaining loss to PL. That is essentially how you are supposed to charge your OCI and your profit and losses. So if any existing OCI is present, net that off first, then move on to your PL. You will do the exact same thing in case of your, so I'll give you another case. In case the first one is a downward revaluation, you will also do the same thing. So I'll give you another case. The asset cost is 100. It was revalued to 40, and then it was again revalued to 200. So this is revaluation 1. This is revaluation 2. Tell me the accounting entries for revaluation 1. What will be the accounting entries for revaluation 1? Both the entries, please. Credit asset 60, debit PL 60. What happens with revaluation 2? What happens with revaluation 2? What do I do with revaluation 2? Think about it. Same thing that we have done with OCI. We netted off OCI first. Here we will be netting off PL first. So what will be the entry? Okay. Do the simple ones first. See, 40 to 200. My assets have increased by 160. Debit the asset, 160. Simple. First, done. Next, what do? I'll have to credit something. I know some PL is existing. So let us net off that first. 60, taken care of. How much will be my OCI? 100. Done. Do the simple entry first. So in any case, if my asset has gone down in value, I know that I will be crediting asset. If my asset has gone up in value, I'll be debiting my asset. So let's just first do the simple entry first. So as long as you're doing the first entry correct, then you can then manage with the second one. So simple. Debit 100, credit revaluation surplus, credit re wait, what? Where is that? Somebody wrote a big answer. Okay, yeah. Is it okay? Everybody getting it? Is everybody getting it? Right. So debits and credits, be very careful. If you are, whatever difference is there in increases or decreases, those have to be accounted for, not the total value of the asset as you did in the first case. So please be very careful when you're using the numbers. Usually, whenever assets are increasing or decreasing in values, the debits and credit part immediately for the asset, that is very obvious. When you are crediting or debiting your OCIs, please do have a look at what other hints may be given in the question. Okay. Now, let's okay. Let's look at something else. Now, whenever an asset undergoes a revaluation upwards, okay, this is done. Whenever an asset undergoes a revaluation upwards, what happens? So let's say I have an asset that was worth $100. It had a remaining useful life of 10 years. Its value has now gone up to $200 and its remaining life is still 10 years. Let's just take this example. Okay. What would be my depreciation in both the cases? In first case, what would be my depreciation? In second case, what will be my depreciation per year? Depreciation per year. This will be what? $10? This will be $20. Simple. 10 and 20. Make sense? Yeah. Now, can you see there is a difference in depreciation? What is this difference? This difference is 10, 20 minus 10, which is $10. Okay. This difference, we call this excess depreciation. excess depreciation. Why do we call this excess depreciation? Because this depreciation comes into existence primarily because there has been an upward revaluation of the asset. Okay. Normally, how do we charge depreciation? Depreciation is a non-cash expense. It is charged to the asset recorded in our profit and loss statement, but it is a non-cash expense. It does not result in any cash outflow. Yes or no? Make sense? Yes or no? Make sense? So excess depreciation, when it comes into existence, it comes into existence primarily because there has been an upward revaluation of asset. If assets have been upward revalued, they've been carried under revaluation model and revalued upwards. In that case, excess depreciation will come into existence. Now think about it for a second. Are you charging this depreciation because you have bought a new asset? No. Are you charging because you have purchased any new assets? No. You are charging this only because there has been an upward revaluation of asset. Okay. So essentially, this expense that relates to depreciation, this extra expense of $10 is only being charged because of revaluation case. Okay. So if that is the thing, this is not an actual expense which is incurred by the business. Okay. So what the IS 16, what the standard allows is you can transfer this excess depreciation to your retained earnings. This is an allowed accounting treatment where you are transferring this excess depreciation to your retained earnings. This can be elected by the firm if they want to. This is an election that is up to the person who's using IS 16. So if I'm a company, I have any assets that are held under IS 16, property, plant, and equipment, I have hold it under the revaluation model. I have a opportunity, I have a option to transfer this excess depreciation to retained earnings. Why? Because this excess depreciation, this particular expense, it is not a real expense because I'm not incurring it because I've purchased a new asset. I'm incurring it because I have hold an asset under revaluation model and its value has increased. It's not a real expense. A real expense would be the one where I'm incurring more depreciation because I've gotten more assets. That makes more sense because depreciation is not a cash expense. It's a non-cash expense that is only charged on assets. If I have more assets, I have more depreciation. Makes sense. I have the same assets, but I'm charging more depreciation now only because the values have gone up. That makes no sense. So that's the reason there is an allowable treatment that you can transfer this excess depreciation to your retained earnings. Makes sense? Does the logic make sense? All of you, does the logic make sense? Why are we allowed to transfer the excess depreciation to retain earnings? All of you, why am I getting only one response? It's 44 people. If you have a doubt, you tell me and I'll explain again. Is everybody getting it? Yeah. Okay. So excess depreciation. So how do we treat this excess depreciation? We can transfer that to retained earnings. Okay. So there is a formula you can use. You can use this formula to calculate. So when revaluation goes downward, is it expense? Then when revaluation goes downward, there is no excess depreciation. Is there any excess depreciation? No. You charge lower depreciation. The value of the asset has gone down. When the value of the asset has gone down, it's a fair chance. Okay. When the value of the asset goes down, why does the value of an asset go down, Milav? Probably because there is a new asset in the market that is better than it, or this asset has already run its course and now is in its last stages, after which it will be scrapped. Yes. So if your asset, technology change, yeah, that can happen. So if your asset is going down in its value, probably because it's not able to produce as much output or is not being as efficient as it used to be previously, should I charge more depreciation or should I charge less depreciation? Think about it logically. Less. So when revaluation goes downward, do I not automatically charge less depreciation? Simple. That's it. So if revaluation upwards is there, can I say that my asset has become more efficient? No. But when revaluation downwards is there, it's usually because of the fact that there is some external indicator that's telling me that, look, your valuation has gone down because of this reason. You can't increase the value of an asset. You can increase the value of the asset because price increase is there and inflation is there, not because it has become more efficient. But you charge a lower amount to your asset or revalue downwards only when there is some indicator that's telling you that, look, this asset is not that efficient anymore. So I can charge that extra amount. Make sense? So downwards takes care of itself, but upwards is where it doesn't make sense. Because when I'm revaluing upwards, does that mean that my efficiency of the asset has increased? No, the same asset cannot increase its efficiency. It is already operating at 100% efficiency. It can only reduce its efficiency, right? So excess depreciation gets transferred to retained earnings. There is a formula you can use directly to calculate in the exam. It essentially says excess depreciation is revaluation surplus over your remaining useful lives. In this case, what was my revaluation surplus? 100. So I would say $100 over my remaining useful life is how much? 10. So my excess depreciation is 10. This $10 can be transferred to my retained earnings. Okay. So when we transfer them to our retained earnings, what will be our accounting entry? We will discuss that with the question. Okay. So hold on your horses. We will get to that question. Before that, we have to discuss few other questions. But there is one good question that I have for you, where you will get this chance to understand how we can transfer. And when we are transferring this to the retained earnings, how the accounting entry changes. Okay. What's the time? 8:22. So far so good, everybody. Can we start solving some questions on this? All good? Perfect. So evaluation upwards, downwards is taken care of. Okay. I'm going to be sending you a few questions. I'm going to be sending you the pictures so that it's easy to follow up, or else you'll have to look through in the book. I'll send you the picture. You try and do this question first. Okay. Be as quick as possible. Okay. Test your understanding, Mon. Can you see the question? It's there in the group. I've already sent. So you have to calculate the cost of the building that will be included in tangible non-current asset additions. Okay. So have a read through the scenario. Tell me what will be the cost of the building. I'll give you 2 minutes. Okay. Others, any answers? Hamiksha says 519. Abin says 519. Salman says 540. Others, quickly, quickly. All right. Let's try and have a look at this question. Okay. Okay. Right. So this is what test your understanding one. Okay. Test your understanding one. What are the costs that I have that I can include? Just tell me. Purchase price of land is 250K. Purchase price of land. Just what's the question? Okay. 250K. I can include directly attributable cost, purchase price, stamp duty. Can that be included? Yes or no? Can I include stamp duty? Yeah. Okay. So 250 stamp duty is 5,000. Can I include legal fees? Yes. 10,000. Site preparation and clearance. Yes, I can't go without it. It has to be done. 18,000. Materials. Now, if you go into your information that is relevant, they've given you some extra information. They've told you that material costs were greater than anticipated. On investigation, it was found materials costing 10 million had been spoiled and therefore wasted, and a further 15 million was incurred on materials as a result of faulty design work. So you have incurred a total of how much? 25 million extra, and that is already included in these costs, right? That's already included in these costs. So how much will I exclude? These 100,000, out of this 100,000 in my material costs, the directly attributable costs will not include my wastage, will not include my um, so faulty design work is essentially abnormal wastage, and so is your spoiled materials. So 25,000 is taken off. I can't include that in my directly attributable costs. Next comes labor. Result of these problems, work on the building ceased for a fortnight during the October of 2017, and it is estimated that approximately 9 million of the labor costs relate to this period. Again, of the entire 150, 9,000 again cannot be directly attributable, and I'm incurring this because I've done some mistakes. I can't account for it as an asset. The architect's fees is 20,000. That will be included. General overheads, I think I should include them, right? General overheads. General overheads, should I add them? No. General and administrative overheads cannot be a part of my directly attributable costs. So general overheads will not be included. What's my total? This is 75,000. This is 141,000, right? It comes to 519,000. Those who got 519, good work. Others, if you haven't, please have a look at it. If you have gotten a different answer, please make sure you're fundamentally understanding what we are trying to do here. Everybody okay with this question? Perfect. Yeah, labor cost, what's the issue? How the distribution is made? I'm not getting it. Send you another question. Please try that. I'll be trying to rectify this doubt. Yeah. How the distribution is made? Who's Vivo? I think that's the name of your phone, isn't it? How the distribution is made? Tell me, please. You tell me how the distribution is made. The costs are related to one period. Yes. But are they directly attributable? Can you attribute the entire 150,000 to one period, to that one particular asset? 9,000 that you're incurring, why are you incurring those extra $9,000? Because of faulty design work and whatever other mistakes that you've done. So 10 million because it was spoiled, and another 15 million was incurred on materials as a result of faulty design work. If you have done a faulty design work, you'll then have to rectify it. That would mean that the labor has to work again and you'll have to pay them more. Any extra cost that you pay apart from the normal cost that you would have incurred, you have paid in this case 9,000 extra dollars because of the fault that you had made. Is that a directly attributable cost? No. Make sense? Perfect. If it was 141K, you would have directly included that, but they have already included those extra 9K of costs that they had incurred because of the mistakes they had done. You cannot attribute for a cost that is there because of a mistake that you committed, right? So that's not there. 7,500, 10,000. Are you answering the second question, guys? I believe it's the second question. Yeah. Okay. Carrying. I'm sorry, what? Which question, Tejas? Are you asking the previous or the same? Which one is it? Example 3? Yeah, okay. The question asks, what's the depreciation charge, not the carrying amount? 2,500. Sometimes someone says 7,500. Okay. Let's have a look. So this is what? Example 3, yeah? So example 1 is done. Let's do example 3. So example 3. Okay. Just this. Have a look at example 3. An asset was purchased for 100,000 on 1st January X5, and straight line no depreciation 20,000 per annum is being charged, 5-year useful life, no residual value. Annual review of asset lives is undertaken, and for this particular asset, the remaining useful life at 1st January X7 is 8 years. Financial statements have been prepared for 31st December X7. What is the depreciation charge on 31st December X7? Okay. 1st January X5, what is 100,000? And I'm trying to calculate my um, depreciation charge as at 31st December X7. Yes or no? So 1st January X5 till. So to reach at 1st January X7, once we have reached at 1st January X7, after that we can charge our depreciation for that year. Yes or no? Because my year end is from 1st January X5, 1st January to 31st December. So from 1st January X5 to 1st January X7, how much depreciation can I charge? They've already given you the numbers. They've already told you that 1st January X5, the straight line depreciation of 20,000 is being charged. So from 1st January X5 to 31st December X5, I'll charge 20,000. Again, I will charge. I'll just do it this way. 1 second. It'll be a little more confusing. Yeah. So 31st December X5, my depreciation 20,000 has been charged. I go another year, 31st December X6, I charge another year of depreciation 20,000. So this is bringing my carrying value at 1st January X7. 31st December X6 is as good as 31st January X7. My carrying value is at 60,000. Okay. Now, what have they told me? The remaining useful life at this date is 8 years. So, carrying value is 60,000 over depreciation over my useful life of 8 years. So, this will be how much? 60,000 by 8, which is essentially 7,500. So my carrying value at 31st December X7. Now they haven't asked you this, but if they had asked me about calculating my carrying value at 31st December X7, how much would that be? 52,500. And they had asked me about what? Depreciation. So I gave them this amount. So you can see they can ask you so many questions. They could have asked you about the carrying value at 31st December X7, or they could have asked you about depreciation at the end of 31st December X7. So 7,500 is my depreciation. Carrying value is 52,500. Is everybody clear? Please check your answers. If you've done any mistakes, please do check your answers. Most of you have gotten the same answer, so it's fine, I think. Can we move on? Is this good? Perfect. Okay, let's have a look at example 3. Okay, let's do this. Okay, next one. We would be doing example, test your understanding too. Okay, have a look at this question. Tell me what the answer is. Let me know when you have an answer, okay? Okay. So you can ignore point one because they won't ask you those kind of questions. Let's just stick to writing the accounting entries. Can you give me the accounting entries? So point two says what? State how the accounting would be different if the opening revaluation surplus did not exist. What I wanted to do is, if opening revaluation surplus existed, what will be the accounting entry? If opening revaluation surplus did not exist, what is the accounting entry? Give me those accounting entries. 14,000. How? Hmm. When am I revaluing my asset? When am I revaluing my asset? End of the year. Yes. Don't you think for that year I'm supposed to charge the depreciation? So how did you get 14,000, Vivo? Check again, check again. So I'll start solving, okay? Because we have two more questions to cover. So first thing is, on 1st April X8, I look at 1st April X8. What's the value of my asset? 100,000. What do I do next? I charge my depreciation because my revaluation occurs at the end of the year. What is my depreciation charge? It's 100,000 over a useful life of 20 years, which is 5,000. Gives me $95,000 of my carrying value. Carrying value at this was revalued to revaluation occurs, and the carrying value goes to 86,000. 86,000, right? Yeah. Now, this is what? Now we have a simple case of downward revaluation. Now, if no OCI existed before, my downward revaluation would have been what? Credit asset 9,000, debit PL 9,000. But in this case, they have told me that 20,000 of OCI existed. So OCI is there. So I will do credit asset 9,000. I will do debit OCI 9,000. OCI was 20,000. There is still another 11,000 of OCI left. Make sense? Is everybody with me? Right? So OCI without OCI. This is the difference. Okay. If previously OCI existed, I would take it away from the OCI. If no OCI existed, I would directly take it to PL. Okay. Remember, you always have to look out when you are revaluing the asset. If you're revaluing the asset at the end of the year, that particular year of depreciation will also have to be charged. Only then you can finally arrive at the carrying value and then compare it to the revalued amount on that date. So if they give you revaluation on any random date, you will first have to calculate the carrying value, the original carrying value of the asset up until that date. After that, you will revalue it. Okay. So do not forget this basic principle. A lot of people do these common mistakes. Okay. These are easy marks. You will be leaving these marks out if you do these silly calculations. Okay. So clear on this point? All good? No issues? Okay. Going to be sending you another question. So try this out, please. Let me know when you have the answer. What is 40, Akash? 3.8 million in loss. Okay. Excess depreciation of 70,000 to retain earnings. Okay. Others answers? Revaluation gain is 2.8 million. Okay. Again, commas, huh? Right. Tell me the value of excess depreciation that will be transferred to retain earnings. That essentially is the answer that I need. 70,000. Okay. 24,000. Okay. So how much is that? If they ask you to write it down in those numbers, then yes, 0.07. So that's 70,000. Yes. 40,000. Okay. Aishwarya also says 40,000. Okay. So many different answers. Yeah. Okay. Let's do this. Let's do this. Yeah. Have a look. First thing, what information have I been given? They've told me that assets worth, a company revalued its land and buildings at the start of the year to 10 million. It has been revalued to 10 million. So there's a certain cost. Okay, wait. There's a certain cost and there is a revaluation. What figures do I have? They tell me that company revalued its land and buildings at the start of the year to 10 million. So this is, let's say, 10 million. So the property cost 5 million, 1 million for the land, 10 years prior to the devaluation. Okay. So they've given me some information on how much it costed. So the property cost 5 million in total. So 5 million was its cost. And then we have, this is my total. This is for land, this is for building. They say that 1 million was for the land and 4 million was for the building. Together it's 5 million. Now they've been revalued and they say that 4 million of the revaluation belongs to the land. So revalued to 4 million. Land was revalued to 4 million, which means that building must have been revalued to 6 million. Simple. Most of you must have gotten this. So I'm just putting information in a table format so that I'm able to understand essentially what's going on. Next step. We need to charge depreciation for what? Who do we charge depreciation? Do we charge depreciation on land? Do we charge depreciation on land? If you would have done that, the examiner is going to cut off a lot of your marks. If it is a descriptive answer, let's say by any chance you get this in a descriptive question, if they have asked you in a small 5-marker question, say, if you would have done this, the entire 5 marks would have been 0 because the examiner goes very hard on fundamental errors. If you make fundamental errors, you will be losing a lot of marks. You cannot charge depreciation on land. You will only be charging it on building, right? So let's charge a depreciation on the building. So I will be working out for the building. My cost is how much? 4 million. Cost is 4 million. And then my depreciation is based on how much? 4 million over useful life of 50 years. So start. Yeah. So 4 million over 50 years. I'll just use the right numbers, okay? The full numbers. So it's 4 million over 50. That comes to how much? 800,000 per year. Okay. When am I revaluing my building? 10 years. It's been 10 years, right? So if it's 800,000 for 1 year, it is how much? Sorry, if it's 80, this must be 80,000, yeah. Sorry, this is 80,000. Apologies, 80,000 per year. And if it is charged for 10 years, it must be 800,000 for 10 years. Make sense? Thank you. Yeah, thank you for rectifying. Yeah. So that's 800,000 for the entire 10 years. So my carrying value at the end of 10th year is how much? It's 4 million minus the 800,000, which is 3.2 million, 3,200,000. Yes or no? And I was revalued to how much? 6 million. Revalued to 6 million. So what is my revaluation surplus essentially? So if I see uh, my revaluation surplus would be essentially 6 million minus the 3.2 million, which is how much? 2.8 million, I believe. Okay. So if it's 2.8 million, that is my revaluation surplus pertaining to the land. I already know, but to my building, I already know my land increase in value has been by 3 million. So revaluation surplus for building is this much. Revaluation surplus for land is 4 million minus the 1 million, which is 3 million. Now, the question is the total revaluation has come to how much? 3 million plus 2.8 million, which is total is 5.8 million. Make sense? 5.8 million. So if I were to pass an accounting entry here, what will be my accounting entry? I will say debit asset 5.8 million, credit OCI 5.8 million. If they had asked me about accounting entries, yeah, simple, getting it? But they have also asked me about excess depreciation. Let's say this company has elected to transfer excess depreciation to retained earnings. So I will essentially do what? Revaluation surplus by remaining useful lives. What is my revaluation surplus? It is how much? Will I take the revaluation of land into consideration here? No, because we don't charge depreciation on it. So land's revaluation surplus won't be taken into consideration, only buildings. So 2.8 million over my useful life of 40 years. They have told me that useful life remains unchanged, which means after 10 years have passed, my useful life would have come down by 10 years. That's it. No other changes will have been there. So this gives me how much? 70,000. This $70,000 will be transferred to my retained earnings. So what will be my accounting entry here? Debit my revaluation surplus 70,000, credit my retained earnings 60,000. Revaluation surplus or OCI, whatever it is you want to use, both of the terms mean the same thing. So you will be taking this to retained earnings 70,000. Is everybody okay? Crystal clear on this? Absolutely clear? No doubts? Everyone? 100%? Hmm? 40 means remaining useful lives. If you look into the question, uh, at the start of the year, it was 50 years. And when you revalued the asset, that was after 10 years, which means that out of 50, 10 years have already passed. So 40 becomes your remaining useful lives. Remaining useful lives. Correct? All good? Okay. So one last question, and we will close the class after that. Or if we have a little bit more time, maybe I will just give you a brief intro of complex assets or something. We'll see. So let's do one more question. Do this, let me know about the accounting entries, okay? Go on. The class isn't stopped. We have given a question. You're supposed to attempt the question. Debit asset 135, credit OCI 135. Okay. But we have sold the asset. 270,000 gain on disposal. Uh-huh. Okay. That's understandable. But what is the accounting entry if I'm not okay? If depreciation isn't transferred and the asset is sold, what is the accounting entry? The asset has been sold, so there will be another accounting entry, isn't it? So yes, PL statement 270,000, that's understandable, profit on disposal. But since this asset has been sold, there is also another accounting treatment that we will have to do with regards to my OCI, because there was some other comprehensive income that was existing because of revaluations relating to this asset. Now, once this asset has been sold, what happens to that OCI balance that was there because of revaluation? Debit revaluation surplus, excellent. Credit to retained earnings. Yes, good. So whenever you sell an asset, you transfer the remaining balance on the revaluation surplus to retained earnings. Excellent. Good work, good work, good work. Okay. Now, let's do this question, okay? So, what are we talking about initially? We are talking about we are at 1st January 14, and the cost of our asset is 750,000. Okay. Our revaluation is happening at the end of first year. So my depreciation that I will be charging will be for 1 year, which is essentially how much? 750,000 over 10, which is 75,000. Okay. This comes to $675,000 as my carrying value. Now I got revalued to my revaluation amount. New carrying value or revaluation amount is how much? 810,000. When did it happen? It happened in 2014. Okay. I got revalued to 810,000. So this is a difference of how much? 135,000. So I will do debit asset, credit OCI 135,000. Okay, my normal accounting treatment, right? This is done. Now, let's come back. So at 2014, after revaluation, my carrying amount was 810,000. My remaining useful lives were how much? 9 years. Okay. Now, 2 years later, in 2016, I'm selling my asset. But I also have to calculate from 2014 to 2016. I also need to calculate my depreciation. So with remaining useful lives as 9 years, what will be my depreciation? My depreciation will be 810,000 over 9 times 2, which is how much? 180,000. This is my depreciation for 2 years. Yes or no? Everybody with me? Everyone with me? Others? Yes, no? Okay. So my depreciation for those 2 years will be 180,000. So my ultimate carrying value on the day of sale, which is that 2016, whatever it is, 810,000 minus I took off 180,000 comes to 630,000. This was my carrying value before I sold it, right? So 630,000, and then I sold it at 900,000. How much gain did I make? I made a gain of 270,000. Of course, this will directly be credited. This amount credited to my profit and loss. Gain on sale. Perfect. But there is another catch. The catch is that before this asset was sold, before this asset was sold, it had some revaluations on it, which means that it had some balance in its OCI. Once the asset is sold, if there is any balance in its OCI, how do we treat it? We transfer them to retained earnings. Because this asset is sold, since asset is sold, so we will debit our OCI or revaluation surplus, which had a balance amount of 135,000, and credit our retained earnings of 135,000. We will transfer the amount that was there in the OCI to my retained earnings. Is this clear? This is only in the case of sale, and if some balance in OCI previously existed that relates to an upward revaluation of the asset that was sold. Only if that asset is sold, in that case, if any balance in OCI was there, that would be transferred to my retained earnings. Everybody good? Everybody okay with this? Okay. I'm going to improvise a little bit on this question. I want you to tell me the accounting entry. I want you to tell me the accounting entry if excess depreciation was allowed to be transferred to retained earnings. What am I telling you? In this question, they have told you that excess depreciation need not be transferred to retained earnings because the company did not make that election. What if I told you that because upward revaluation was there, I was allowed to transfer excess depreciation to my retained earnings? In that case, how will my accounting entry change? What happens if excess depreciation was transferred to retained earnings? What happens? Tell me. Tell me what the accounting entry will be. Debit revaluation surplus 15,000. Debit revaluation surplus 15,000. Credit to retained earnings 15,000. Okay. But asset is again sold. Then what happens? Also, check your numbers. Yeah, okay. This entry is fine. For 1 year, this entry is fine. But the entry that I want is how is that going to affect the numbers when I'm selling the asset? Because I know that when I sell the asset, everything in my OCI gets transferred to my retained earnings. So how is that going to change my accounting entry? Is it going to change? Is it going to stay the same? Will these numbers change? What's going to happen? Think about it. Tell me. Debit OCI 120,000, credit retained earnings 120,000. Think again. You're forgetting one key hint. You're in the right track. Vivo. Hey, how many Vivos are there in class? Hey, write your names from next class. How will I know who is speaking? You're in the right track. Vivo Y28S. But you're not quite there. Think again. You're missing one critical information. Read the question again. Maybe you'll find it. Let's see who gets it. Excuse me. Yeah. Debit depression? Did you mean depreciation? Accumulated depreciation. Okay. Hmm. Mm, the counting entry. Nope, not quite there. No. The numbers are right. The numbers are correct. 105 is right. Debit OCI 120 credit retained earnings. No. Nope. Debit profit on disposal. Nope. Yes. Okay, let me do it. So essentially, what am I doing? If you come back here, how many years of depreciation did you charge? 2 years. Why? Because from 2014 till 2016, when it was sold, up until that point, there was revaluation. When revaluation did happen, it happened after 2014 and remained till 2016. After that, the asset was sold. So essentially, when I'm calculating my excess depreciation, how do I do it? Excess depreciation is how much? My revaluation surplus, which was 135,000, divided by remaining useful lives, which come to how much? 15,000. But this 15,000 is what? Per year. When am I selling the asset? I'm selling it after 2 years of revaluation. So essentially, that will be $30,000 worth of excess depreciation that will be transferred from my OCI to my retained earnings. Yes or no? Excess depreciation gets transferred from where to where? Excess depreciation gets transferred from my where? Tell me. Excess depreciation goes where? To my retained earnings. From where? From my OCI, right? So if 2 years worth of excess depreciation has already been transferred from my OCI, how much balance remains? So OCI balance at the time of sale was 135,000 minus 30,000, which is 105,000. At this point, you sold the asset. So when you sold the asset, what will you do? The entire OCI balance will now be debited 105,000 and you will credit retained earnings 105,000. So that will be the entry. Getting it? Is this okay? If you didn't get it, tell me, I'll explain again. The only difference here is my excess depreciation that I transfer to my retained earnings. In the first case, I was told that I did not transfer anything. So my entire revaluation surplus was there in my OCI. So I transferred the entire 135,000 upon sale to my retained earnings. But in the second case, I'm already transferring my excess depreciation on a regular basis to my retained earnings. So $30,000 worth of excess depreciation was already transferred. So out of that 135,000 that remained in OCI, 30,000 was already transferred as part of excess depreciation to my retained earnings. So out of 135,000, only 105,000 remained. And upon sale, that 105,000 also got transferred to my retained earnings. Does that make sense to all of you? Amiksha, Abin, Milaf, Shama, is that all okay? Are you guys all okay? Okay. Any doubts? Aisha, Tejas, Aishwarya, Salman. Okay. Good, good. Leona. Good, good, good. Okay. So this is probably the maximum amount of difficulty I can say because these questions you will not find because I take questions from multiple sources from BPP, Kaplan, sometimes Study Hub. And this was one of the questions which I found was very interesting, and it would be in many cases a little intimidating to students. I think IS 16 does not get any more difficult than this. Okay. So if you are able to figure your way out around these kind of questions, I think you are very well placed from an exam's perspective to answer difficult questions as well. Okay. So if you class notes, these aren't notes as much. I mean, like if you want to, you can just, like revisit the class as such. I don't really maintain these notes. I don't know if this can be sent over to you. Because I just scribble. Um, as such, I'm not providing any notes in the revision class because I just solve questions. So as such, there's no notes as such. You can refer to Kaplan because most of the descriptions that I use in the class, they're from Kaplan itself, sometimes a little bit from BPP. So as such, I don't really maintain any notes because I only take revision classes. I solve class recordings you can access. Um, I think you were sent, what do you say, a Google form, right? That was because the team wanted to give you access to the online learning portal where all the videos will be uploaded. So if you were to access those, then you can revisit the recordings directly. Okay, that you can do. Yes, we will solve BPP kit questions. If you have looked into BPP, make sure they have a combination of three things: IS 16, IS 40, and IS 23 together. So what I will be doing is I will be solving individual questions first, and once we have finished all these three standards, I will solve a few questions from BPP. You can start solving the questions which relate to IS 16 because you've already solved the most important major ones. There's only one part that remains, complex assets, which is pretty obvious, honestly. So, that can be done tomorrow within no time, and then we can move on to IS 23. So, yes, you can start solving those questions as well. I will pick up the most difficult ones to solve in class. Uh, yeah, got it, got it, got it. That's the reason I've just been scribbling notes. I don't want to get much into the theoretical aspects because I also wanted to solve more questions. So yeah, just a little background about the standards, and then we will shift to solving questions. Okay, that's essentially how we are going to be doing it. I've picked up the most trickiest, the most good questions that are there. If you're able to solve these in class, I think you will be placed very well to solve the others as well. So that won't be an issue for you. If you even attempt now, start attempting for IS 16, I think you should be able to solve most of them. Right? So we have two or maybe three more questions that we will look into from complex assets perspective. Maybe one more question about that I feel like I think you would be able to deal with that question. So maybe one more question from complex assets, and then I'll move on to borrowing costs tomorrow. And if I get time, we will start off a little bit about investment property. Okay. So kindly go back, revise it. If you want, you will have access to the recordings as well from the learning portal. Make sure you sign up on that Google Drive link that was sent to you so that they can collect information and give you access to the learning portal. If you are still not getting it, you can get in touch with the administrator. The numbers are there in the group. My Logic, it must say the name My Logic, something like that. So please do get in connection, touch with them. They will let you know about how you can access the learning portal. Okay. All good? Liking the class? Is the pace okay? Okay. Fine. So come back tomorrow. We will discuss complex assets, move on to borrowing costs, and if time permits, maybe investment property. Okay. All right, guys. Have a good night. See you tomorrow, same time. Yeah. Bye. Thank you, guys. Thank you. Thank you, Elena. Thank you, Abin. Okay. Bye, all.